Welcome to a special episode of the Create Wealth podcast. I'm Sandeep, your host and co-founder at Deserve. Today, we are celebrating our 25th episode with a curated montage of insights from India's top wealth creators. Over the past 1 year, we have interviewed 24 incredible entrepreneurs, founders, and investors to explore their journeys of building wealth. In this episode, I want to share my favorite and most insightful takeaways from these conversations. Here's a curation of our guests revealing all the routes to wealth creation. Wealth from salaries and bonuses, wealth through ESOPs, wealth from selling businesses or stakes, growing generational wealth, and as a bonus, wealth creation through content. Let's dive in. Salaries and bonuses are probably the most common routes to wealth creation. However, given its linearity, it is often one that requires the maximum discipline. This is how Radhika Gupta, CEO of Edelweiss AMC, puts it. Do you personally feel that you are wealthy?
Yes, I do. Not in the traditional sense. Look, I'm privileged. Anyone who's sitting here is privileged living in India. So I'm not going to lie and say I'm poor. I'm not. I'm well paid, well invested. Wealth is always relative because I've realized that there's always someone richer than you. But unfortunately or fortunately or whatever it is, there are people who have significantly less than you. But I'm very happy.
Radhika, so you were at exit forefront, 1 lakh rupees salary a month. How much money did you guys get when you sold forefront to Edelweiss?
Okay, I'm not going to answer that, but I will tell you that we got some money, so that was nice. And we got enough money to at least put some corpus into a house. I don't own Samudra Mahal before people start guessing how much money I earned. But we got some money to put into a house. So that was nice. And we also had, which is important, not just an upfront payment, but incentives because we sold the business to Edelweiss to build over the next 4 years. So we also had incentives that were linked to building out over the next 4 years, which actually were a very important part of the deal consideration. And I think those incentives were actually larger than the upfront.
Radhika, as a part of this discussion, I had the good fortune of trying to research how much CEOs get paid.
Oh, God.
Right? And the data points varied between 5 crores to 10, 15 crores a year.
Okay.
How does the CEO of an AMC compensation is structured? Tell us a little bit about that.
Okay. So firstly, you can find out, guys, what all CEOs get paid if you have a folio number. So you can just go to anyone's website and get it. It's the law. So there's no secret about it. How do CEOs get paid? Most people, and it is a little different person to person, will have a component of fixed compensation, will have a component of bonus compensation. Now, what is the split between fixed and variable? It's really dependent. I've generally observed in financial services, as you get more senior, bonus is a very important part or meaningful part of your compensation. And CEO compensation is approved by boards and NRCs and all of that. In addition, most CEOs will have some kind of long-term incentive. Depending on the company, it could be ESOP, if it is a listed company or an unlisted company. It could be shadow ESOPs, which are long-term incentive plans, but something linked to the performance of the company that is deferred that you get as compensation is a third part. So for most people, these are the three parts of compensation.
So how is your own portfolio got determined because of that? Because 20% of your annual meaningful number incrementally is going into your own funds. अब उसके बाद the surplus money, what do you do with it?
I do SIPs, very simple. I get a monthly salary. I do SIPs and when this happened, I was going to top up my SIP amount because I think one of the things that we often forget is that our compensation is rising as salaried professionals. And net of expenses, we have some money left. So that should go into savings or SIPs or whatever it is. We don't realize our compensation is growing and we haven't changed our SIP amount. So when this happened, I just adjusted my SIP amounts. So that's what I did. I do SIPs. I can tell you the funds I do SIPs into. I do SIPs into balanced advantage funds, into mid-cap funds, small-cap funds, select international funds, and one passive fund. That's basically it. Maybe about 8-10 funds in my portfolio that I do SIPs into. Bonus compensation, I have to be a little more thoughtful because it's a lump sum payment that comes. So I always find large lump sum payments tricky because then, you were sometimes what I do. So the math I have done now is I figure out my total net of tax compensation for the year, taking out this 20% deduction, taking out my expenses, and I set that SIP amount. Okay. Now, this is a little technical, but that SIP amount is actually very high. And I take out EMIs and whatever else I have there. That SIP amount is high. Some of it goes from my monthly salary. The bonus amount I leave in an arbitrage fund, and it also keeps STP. I don't like to do large lump sum deployment.
It's very interesting you say that, Radhika, because having managed money for 20 years, I feel the worst investment decisions are when you have the large amount hitting your account. Because you are on a high in a moment because suddenly like whatever 10 lakhs, 25 lakhs, few crores is hitting your bank account. And at that point of time, you feel like deploying it in what seems right then. Right. And typically that's not usually the best
I have
investment
made
option.
this mistake in 2006-7 because again, similar compensation structure on Wall Street. There too, it was a lot more skewed because fixed comp is very low. High variable comp, deployed it all into equities at 2007 peak. I mean, just a horrible idea.
Yeah.
So now I am okay. I mean, I was just looking at an account yesterday that I still have a large amount of money sitting in an arbitrage fund. And I was like, this is a lot of my bonus. Then my husband and I were chatting. He's like, remember, your SIPs are large, so it's just going. It will go in an STP format because it's just an easier way, I feel. You make less mistakes.
Lump sum gains and large liquidity are truly challenging to invest. But I remember my conversation with Shashank Mehta, founder of Whole Truth Foods, whose transparency in sharing his investment framework might help you see how lump sum gains can be invested into real estate. You were at Unilever, you went to Rebel Foods or Fasos, and then you came back to Unilever and then you started up. What was going on during this process? Like, because as somebody who's on a fixed salary and doing really well, and the fact that Unilever wants you back after some time, you would probably be doing really like well in the relative terms there, right? Or uske baad then to give it up and go back to zero salary and earn it back again. How was that experience? And as founder, how do founders think about salaries? Like when did you start taking a normal salary? Are you taking a normal salary? ये 1 crore बनता था, are you making 1 crore right now or not?
No, I'm not. तो मैट्रिक्स वालों को तो जब मैंने बी प्लान सबमिट किया था, मैंने अपनी 25 या 30 हज़ार रुपये महीने की सैलरी डाली थी कि मेरे को कॉफ़ी पीना बड़ा पसंद है अच्छे कैफ़े में बैठ के, उसके लिए मेरे को बीवी से पैसा नहीं मांगना, बाकी उसकी सैलरी से चला लेंगे, मेरे को इतना पैसा चाहिए कि मैं अपना शांति से कॉफ़ी वॉफ़ी पी पाऊँ. I categorically remember both Avnish and Vikram were like, dude, don't be stupid. Please take it up to a level where we are not sitting worrying that मेरा फाउंडर सड़क पे खड़ा है और सोच रहा है कि ऑटो लूँ कि ऊबर लूँ. Right? So, and I'm very happy sharing numbers. Maybe it'll help some younger founders because I am still told that I take lesser than what I should. And I still don't know what the answer is, right? So, I started off by taking 1 lakh a month. So which was, और वो तो कुछ टैक्स स्लैब भी बहुत कम लगता है, तो कुछ 13 लाख रुपए की CTC टाइप कुछ बैठती थी उस टाइम पे. सीरीज ए के बाद आई टुक दैट अप टू 20 लाख अ मंथ, एंड सीरीज बी के बाद आई हैव टेकन इट अप टू 35 lakhs a month. That's been the progression. And I hear both sides of the stories. Most people tell me, पागल है तू, इतना बड़ा सीरीज भी करा है, तेरे को ज़्यादा लेना चाहिए. Some people are like नहीं ठीक है. So I don't know.
हाँ नहीं, वो एक तो I totally believe that at least आप comfortable होने चाहिए. Comfortable not in the sense that you have savings after.
Sorry, did I say a month? 35 lakh की CTC.
So it's a good place to be in, right? But you should be comfortable with it. So Shashank, if I am on a salary, every month, let's say 3 lakh rupees hits my account, 1 lakh rupees gets spent, 2 lakh rupees gets spent, the remaining is then invested. So what I've normally seen is when this money is getting invested every month, people are generally good about that investment decision. But aapka secondary hua. When secondaries happen, people get 3 crores, 5 crores, 10 crores, 25 crores, whatever that amount is, into your bank account. And when that happens, there's a lot of interesting decisions happen. Some people say कि I deserve a car, अब मेरे को एक बड़ी गाड़ी लेनी चाहिए, or I should take this international holiday and fly business or first class, etc. So people have many things going on in their head, right?
Yeah.
How did you guys think about the money that came lump sum in a big way on a certain day in your bank account? Suddenly, like, आप zeros count कर रहे होते हो उस दिन.
Great question, yeah. To be honest, like, I didn't have a framework for it. Because as I said, I am a person who doesn't think about money. Like, I'd spend zero time every day thinking about money. And as I said, it doesn't mean that I'm some, aesthete sitting on a cloud saying, monk, ki, Are, I like the good life. But in my head, money has always, thankfully the education etc that I've had, I've always earned enough कि मेरे को जो अपना lifestyle चाहिए वो मैं maintain कर सकता हूँ.
Correct.
Right? So money has always been for me, the only job of money is that I shouldn't have to think about money. That's the only job of money in my life. Right? And I spent zero time over the last 15 years of my career thinking about बहुत पैसा होएगा तो क्या करूँगा. Right? So I didn't have any framework for it. I was clueless. आ गया पैसा अभी, and it was just a number on an Excel sheet or on a screen. Like उसके मायने भी क्या है मुझे पता नहीं था. Right? So I was clueless. So then me and the wife, we started discussing, and we had a later on I've realized that every founder goes through this thing. कि पहले तो आप बोलते हो कि अच्छा इसको बड़ा स्मार्टली इन्वेस्ट करेंगे, फिर आपको पता लगता है कि कैपिटल गेन नाम की चीज़ होती है, टैक्स भरना पड़ता है. अब फिर उस नंबर पे जब सीधा 20% हटने की बात आती है तो वो इटसेल्फ इतना बड़ा नंबर होता है कि आपको लगता है कि यार ये तो नहीं करना, कि कैसे बचाएं ये टैक्स. गवर्नमेंट फिर एक ही तरीका छोड़ती है टैक्स बचाने का कि आप इसको रियल एस्टेट में डाल दो. राइट. बॉम्बे में रियल एस्टेट में डालने जाओगे तो जितना भी बड़ा आपको लग रहा नंबर है वो छोटा है. वो बड़ा तो है नहीं. राइट. सो एंड ये मैं सबकी नहीं, मैं अपनी कहानी बता रहा हूँ ये कि यही हुआ कि एंड लाइक टू बी ऑनेस्ट इट ऑल्सो वॉज, आई रियलाइज कि अगर मेरे पास फ्रेमवर्क नहीं है एंड अ लॉट ऑफ पीपल हैव in silent passive ways contributed to this journey because of which this outcome has come.
Yeah.
Right? So, and in this case that's the wife.
Yeah.
Right? If she has a leaning towards something, that gets weightage over
that's highest on the totem pole.
That's right? और especially अब मेरा कोई strong point of view नहीं है. Right? क्योंकि मैंने तो इस बारे में कभी सोचा ही नहीं है तो कैसे होएगा. तो हमारा वो टाइम आया, एक हमने फुल डिस्कस किया कि अच्छा टैक्स दे देते हैं बचे हुए पैसे को इस इंस्ट्रूमेंट में, यहाँ ये वो करके डालेंगे. 15 days of doing this and I was like, wait, the only reason that this money has come is because the last 15 years of my life or whatever years of existence, I have never spent a minute thinking about money, and I've spent every minute investing in myself, improving myself, learning, etc., which is what led to the startup, which is what led to the startup doing well, which is what led to the money. Why am I changing that tenet now? Why is it that the last 15 days all I've been thinking about is money? This is value destructive. Right? If I let go of this decision and we do whatever we collectively think is not a bad idea, टैक्स बचाओ, रियल एस्टेट में डाल दो, घर खरीद लेते हैं, घर वाले भी बोलते हैं कि अपना घर होना चाहिए. मुझे लॉजिकली नहीं समझ में आता. मैंने कभी घर के बारे में भी नहीं सोचा अपने कि मेरा घर होता तो कैसा होता, मैंने ये भी नहीं सोचा कभी. एंड आई नो फाइनेंशियली बुरा ही डिसीजन है. राइट.
While we are on the topic of wealth creation, we can't avoid the hot topic, ESOPs. In one of our most loved episodes, Mukund Kulashekaran, the Chief Business Officer at Urban Company, shared some brilliant insights on how his wealth creation got a big boost through his ESOPs. When you switched from BCG to Zomato, probably what was not super clear, or maybe it was, that ESOPs or share of equity in the company is a large part of compensation, right? How did you think about that? Was there a negotiation around that? Was that sort of renegotiated at every period intervals? Talk us a little bit about that.
So firstly, I think understanding ESOPs took me some time, in all honesty, right? But I fundamentally realized just salary is not going to create wealth. I think it's very clear in my head, because if you do the math as a consultant, you work a very long time to create good wealth, because you're at the end of the day, you're charging client a charge for your hour.
Sure.
Beyond a point, it's capped.
So in a way, you're renting your time and time is limited.
Exactly, right? Because then I have to keep stretching my time, which I think beyond a point doesn't make sense. So it was clear that you have to own some part of a business to really create wealth. And of course, that then has a higher risk. Of course, right? This risk reward is very clear in everybody. So to start with, first I knew I can take the risk because my OPEX is low. So like karna hai to fir let's go for the home run. Any which way, it doesn't matter. So let's do the home run and see what happens. I think was the thought. So hence I knew ownership is important. I of course didn't know how ESOPs, investing and all of this work. I think I learned over a period of time and realized, oh my God, this is a little bit complicated and I actually need
and
to
how
learn.
Important that is.
Yes. I didn't know vesting kya hota hai, holding period kya hota hai, and like strike price. There's so much nuance to it. I think I only learned that maybe 2-3 years in, to be candid, not upfront. And I think most founders are also employee first, because they realize if you don't do this right any which way, people will not stick with you. So to that extent, I don't think understanding it makes a ton of difference, but I think you'll go with your eyes wide open.
Sure.
So I think that's good to know. So to answer your question, yes, I did negotiate. I in fact negotiated such that my cash was lower and my equity was higher. So I think they were also happy, because you can't keep both and say, because I've had a few people even negotiate with me saying, I want you to match my cash and give me equity. I'm like that doesn't make economic sense for any one of us. Like you have to take some trade-off.
Sure.
So I was, I think, fairly willing to do that. I dropped my cash, not just my bonus. I removed my bonus out of consulting and I dropped my base pay further. And I converted all of that into equity in some form or the other. So that I get a much higher X. So starting, that was the simple math. 1 year, 1.5 years in, once they knew how good I was, then of course the conversation was very different. Saying, you can see the value I'm bringing to the table. What do you think is the right way to think about equity?
And was it like proactive from your side, or sort of like a appraisal linked conversation that was happening as it went?
I would say it was mixed, at least at that point in time, because I think the good part is we all work closely, so people can see what value you're bringing to the table. So folks were also kind of already nudging me towards that. And then I was also like, should we talk about it? I don't think I was so mature. So I do think now I've gotten a little bit mature on how to have that conversation. I think it was a little bit more, I think I find it very uncomfortable to talk about compensation, to be honest. So it was like this awkward conversation saying, should we look at equity again? But then I think as soon as I started the conversation, it moved so fast. So I realized that there was trust on both sides.
The thing with ESOPs is that how do you figure out what's the right number, right? Because when it comes to cash comp, there are benchmarks that you can put at it, and in your mind, you can rationalize it. But when it comes to ESOPs, there are no real benchmarks, right? Your company is worth something else, some other company is worth something else, so you can't compare that. Even within your company, you can't compare with each other. One is private, two, roles are different, right? So how was that thought process going on? Like this is the right amount I should ask for?
I think thankfully, I didn't ask for an amount. I first said, should we reconsider this? And then, in fact, the conversation was, okay, how should we do it? Because I assumed it's not only my problem, right? Like there were a bunch of us who were all building together. So I think, hence it became like a little bit of a math exercise saying, okay, how do we determine this number? And then we realized, okay, let's say we all want to create at least this kind of wealth for all the core folks. And if that's the kind of wealth we need, what's the kind of equity we need to make that real, with an assumption that a lot of it will come from compounding. Because one has to also realize that it cannot come from grant size of beginning. I think this took me a while to understand.
No, explain this. This is very interesting.
So let's take Zomato's case as well, right? From the time my ESOP was given to today, we are at a 12-14x appreciation.
Okay.
So you have to believe there will be appreciation. You can't believe there will be a 4x appreciation and negotiate equity. But then you're pretty much asking for a huge chunk. And also you're assuming I want to make overnight a lot of money. If a company grows, I think at 25% for 10 years, it's 10x. And if it grows 25% for 15 years, I think it's 30x. Mota moti. Like that's the number I hold in my head. So just to keep, because compounding is difficult to remember. So I remember some 2-3 numbers so that I don't.
So 25% is your money is doubling every 3 years.
Exactly.
Give or take. So in a 10
rule
year
of
period,
72.
2 to the power 3, and therefore.
Exactly. I do the rule of 72, right? So it's just easy to kind of keep the broad math right. So I knew I should at least take a 10-year view of this. And I knew whatever I will get, I can get maybe a 10x appreciation because I could see a CAGR of 25-30 at Zomato. It's not going to be slower than that. So I was like, okay, I should take a 10x of this, and would I be comfortable at a 10x of this? That number seemed good. And it was very generous, to be very honest. I was like, okay, this actually makes me feel uncomfortable that I am valued this much.
I truly believe that how to create wealth through ESOPs will be a problem statement many new age Indians will have to solve. Let's move to another scenario. Sale of business or stake is a rare liquidity event, and most who achieve it should have a solid framework to deploy it. Jitendra Gupta, founder of Jupiter, created significant wealth when his company CitrusPay was acquired by PayPal for $130 million. It is interesting to hear how his investment framework actually turned out to be different than what he had imagined.
Obviously, Citrus was a financial outcome where you had a financial surplus. At that point, how did you start thinking about deploying that capital, real estate, financial assets, private equity, venture capital? Walk us through that particular journey.
Sure. So the framework I adopted back then was, though that framework has not, I have not stuck to that framework, but at least I'll share what I thought. The framework I thought was that I'll put 70% into the public equity, 20% into the private market, which is the angel funding and all of that, and 10% into the fixed income. That was the framework I thought. Now when I look back, the way it has played out, it is like almost 50 to 60% into the private market, 25 odd percent into the public market, and the rest is fixed income.
Okay.
So now when I look back, I would say when I deployed the money back then, that was the best time. The valuations were more reasonable.
In private markets.
In private market. The founders were more hungrier, and they were not doing it just for the sake of starting up.
Sure.
So ROI on those investments have played out really well. It has changed now. And this is where I realized two things. One, from a personal investment standpoint, it consumes a lot of time. With Jupiter, I think I'm not able to devote time to the personal investments so much anymore from last 2-3 years. So we said that this approach can't work, or it's not scalable.
Sure.
So we thought of creating a more structured vehicle to do the investments with a team in place and all of that. The public markets, I took a lazy approach, invested in 2017, say, and till date I've not touched any of those investments. And whatever redemptions had to happen, they happened, but most of the investments are still intact. I would say the lazy approach really worked, where I didn't have to pay fees as well as worry about churning the portfolio and all, because when I invested, I took a more conservative that let's put in the large caps, some bit of mid caps, but I'm not doing this exotic structured investments and all of that. And it just worked. Like ROI, the IRR on those are being, like when I checked recently, like 15-16%.
Yeah.
I'm happy with that.
Yeah.
I don't need 25% IRR.
Absolutely.
So that's, and fixed income, anyway, you do expect 10% IRR max.
Yeah.
9, 10. Nowadays, I don't know if it's possible. But back then, when I invested into a few instruments, they continue to give that kind of IRR. So again, very lazy.
Right.
Not done anything around that after investing. I think in hindsight, I feel there's a best approach as well. You rather take a conservative approach in investing into the large caps and the index funds and all of that, and then not worry about managing it actively.
And juicing out the last
penny.
penny.
And juicing out the last 1% or 2%.
Yeah.
Like Jitendra, we have one more wealth creator who invested smartly after a $55 million sale of his business. More often than not, on receiving substantial capital, most investors buy real estate. Let's hear from Avnish Bajaj, one of the most astute investors I know, about his framework to make big returns from real estate. Avnish, one of the most interesting things, I was doing some math around this. 2004, and this is what Matrix website says, you exited Bazi for $55 million.
I was trying to compound it at 15%. And today that number will be just short of $1 billion.
Yeah.
So in today's value terms, it was almost like a unicorn exit.
Yeah.
And yet, after such a successful exit of its time, you decided to become a venture capitalist. Why did that happen?
If you look at all the top consumer companies in India, the founders actually got diluted down, sadly, to single digits. We were somewhere in that range. But I think it's still a good question. And by the way, my kids remind me that if I had not sold, we would be billionaires. And I tell them that it wouldn't change my life. And they're like, we don't care, it would change our life. But it would not be, it doesn't work like that, right? Would we have given Flipkart a fight? Probably. So it could have been a very different thing, but zero regrets, genuinely. I think for your audience, it may be an interesting story. I have taken the hardest path to the same outcome that people could have taken. You know the business, you compounded it. I have not stayed long enough in things to compound, and that's been my big learning, and which is why I'm going to do this forever, what I'm doing now. So I joined Apple Computer when Apple at one point was worth 600 million, Microsoft, and I don't know, split adjusted, I had once done the math. I had 5,000 shares at the time, which today would be 700,000-800,000 or something like that, and you know the value of the stock. Anyway, when I did the math, it was very, very large number.
Sure.
Then I joined Goldman Sachs before it went public. I had a big stock grant. I left as soon as they went public, and that stock went up a lot. So actually, like for like, when I did the math after Bazi exit, I was worth the least than if I had stayed at Apple or stayed at Goldman Sachs, right? But I enjoyed it the most. So I think that kind of is the reason why I'm doing what I'm doing, because money is just an outcome. People generally who are too focused on the outcome, they tend to take shortcuts, which is what I was taking. I did start Bazi in the dot-com bubble because I thought I could make a lot of money quickly. It was not quick. It was very painful. And money, in my view, is a gap between your means and your wants, and whereas it should be the gap between your means and your needs. And people confuse their wants and their needs.
Coming to a personal discussion around how you manage your money. And before that, like today, if you were to have $100 of investment surplus, how much of that was created in the Matrix journey and how much of that was created courtesy of the Bazi exit?
80-90% Bazi.
Even today? Wow.
Whereas the VC industry paid off yet. It's starting to pay off.
Right. Got it. So how do you then invest?
So I got lucky. I bought in Bandra real estate at 4,000 rupees. What do you think? Today, Kandivali is 50,000 or something like that, right? So I caught 2 or 3 cycles of 3x in real estate in India. Real estate has always fascinated me. I had one first principles of real estate correctly in my head from the beginning, which is rental yield is greater than interest rate, only then buy, otherwise sell. I just applied that 3 times consistently. Right?
You got 3 times opportunity to be able to do that.
So 2003, bought, sold in 2006 or 5, then bought, sold in 10, and then bought, sold in 14, and that's it. After that, market didn't move. Now, latest one, I don't care. I'm just looking at it as more personal thing. Right. So 3 times on that, and equity markets. Both I started early. Also, I was not shy of leverage. So I was backing myself. And I used to always say only equities and serious debt for real estate because it's asset backed. Right? Sure. But it was just instinctive to me.
I'll just explain that. Yeah. I'm assuming you mean that when you bought real estate, you took a loan for that, whereas on the equity side, that was funded from your own capital. You didn't borrow to invest.
Correct. No margin trading and all that, because I lost my entire net worth in the dot-com bust in the US because of margin. So I had learned that lesson. So, but I always bought beyond my means because I said I will take debt. And Indian interest rates had started to moderate. They weren't crazy anymore.
Yeah.
One could see, and again, being a believer in India. So I was way overweight real estate. Maybe up to 60-70% of my net worth. Then at the right time, I started kind of dialing it down because I've always believed equities is the right answer. Never in fixed income, zero in fixed income, even now. So I knew my future net worth is all going to be in equities, but in the riskiest asset class, which was private equities, and in technology. So I knew most of my future net worth will be this. So I didn't want most of my present net worth to be that. Right? So real estate seems real. And again, got lucky with the timing of the market. Equities also. I have at different stages sold equities to pay off debt because I never wanted to screw up cash flow. And there have been instances, there have been again many crises along the way, right? And I wanted to keep investing in our own funds. Future net worth 10 years out, this will be 70-80%.
It's amazing how missing out on investment opportunities can change your outlook on whole asset classes. Let's take it up a couple of notches and hear from wealth creators on the top of the pyramid. Growing generational wealth or family business wealth is a whole different ballgame. Unlike the previous cohort of wealth creators, family wealth is different in the sense that they are not seeing substantial wealth for the first time. Their long-term lens on wealth is what sets them apart. Here's my favorite takeaway from the conversation with Aarti Gupta, who manages the family office of the Dainik Jagran group.
But in general, I think as the Indian economy is progressing and as more and more family businesses are converting into business families, right? Where they're separating business from individual families and there's a concentration of private wealth. I think that's when the concept of family office sort of emerges because the families realize that we need like a home vehicle, right? To take care of families' needs, which is outside the realms of the business. When I started sort of looking into it, we're a typical Banya family, 80-90% of our assets were in FDs, right? So over time, we've sort of moved to a more sophisticated and a well-balanced portfolio. But I feel the way at least we approach dividing or investing is through wealth pools. And the concept of it, honestly, I first learned, I went to Wharton to do like a course in investments, and I attended Professor Ashwin Chabra's class. And he's written this book called The Aspirational Investor, where he talks about wealth pools, right? And I found that concept so fascinating because that's how I feel that truly one should, at least a family of a sizable corpus, should approach investing, right? So that's how we do it. We divide our wealth into different pools. We have a safety pool, we have a lifestyle pool, and we have an aspirational pool.
Interesting.
And each pool has X amount of money allocated into it, and each pool has its goals defined, and then we take risk and asset allocation accordingly, right? Ours is about 10 to 12% in the safety pool, 10 to 12% in the aspirational pool, and the rest in the lifestyle pool. That's how we approach
So
investing.
it's very interesting you say that because even how we think about asset allocation is about income, growth, and aspirational or growth plus, right?
Yeah.
And the conventional approach has been that you have a percentage of the overall pie, which you keep readjusting periodically, right?
Looking at investing from the lens of wealth pools was a huge learning for me. At its core, it's still about asset allocation. Here's how Rishabh Mariwala of Sharrp Ventures, the family office of the Marico Group, looks at wealth creation.
Like, how much do you think is the amount of money it needs before you should do this?
Yeah, so I think, it just really doesn't make sense when you do it. It has to be above 100 crores. Anything above 100 crores makes sense. I think we've had the wisdom, and it's borrowed wisdom from my father, but it is at least within the family that be disciplined in your approach. So just very, very clear guardrails, and don't do. I think initially itself, it's like fine, you play, but you dip your toes, dip your feet in the water, but don't go in completely. Otherwise, you'll be swimming naked when the tide goes, right? So just go very, very slowly. So initially, it was 90-10, 90% listed, 10% unlisted.
Got it.
And we did the 10% was a mix of funds and direct, and even the direct deals. Initially, it was, hey, this is someone who's doing it. Why don't you piggyback on them? And that's when we learned what a term sheet was. That's what we learned what a shareholder agreement was. That's when we learned what diligence was. That's when we learned to deal with the entrepreneur, how to help the entrepreneur, what to do, and what your rights are. And I think that process really helped us sort of decode and understand. It's an ongoing journey, but at least upfront we got some of that schooling and education through doing those deals. And we had done deals in very different industries. So everything from beer to even hardware for security devices to clinical trial companies. And I think that was the experimentation phase. That from 2015 to 20 we did some of these deals. We did like deep tech funds, or tech funds, and of course we did consumer as well. But come around 2020, just when I'd sold the business. So I'd sold Pure Sense was the brand. I'd sold that, and I was full time into Sharrp, which is our family office. And at that time, that's when we looked back, right? We had 5-year data, and we said, okay, fine, what are we really doing? Do we really know the companies that we're investing in, and do we have the right to invest in industries and categories that we don't understand?
Got it. So earlier you were more passive investor, sort of taking somebody else's lead on it, and then you decided that now it's time for you to sort of go deeper and select those companies more precisely.
Exactly.
Summing up the family office conversation, I recall my recent conversation with Sunjay Kapur, chairman of Sona Comstar. His focus on being involved in every investment decision regarding the family wealth was pleasantly surprising. He likes to keep it simple. Here's how.
As far as the family office is concerned, we have a good concentration of public equities. We have a few small private equity investments we've made, some safe capital, in this safe bucket. Art is an investment class, and we have looked at art in terms of the fact that the value of art's gone up drastically, and it's good to have. But again, we try not to do too much. Again, you want to keep it as simple as you can. With public equities, the notion is that we want it to be compounding, and over a long period of time, it should give you good returns. That's the way we look at it. We work with good managers, and my wife and I both sort of get involved in the review process. We do a formal review every month, but we're always looking at what is happening in terms of public markets, in terms of private equity or venture capital opportunities.
Having monthly reviews of your investments, whether large or small, I believe is very critical. Monitoring your wealth is just as important as creating it. As promised, we've saved a bonus cut for the end. When I spoke to Raj Shamani, one of India's most popular content creators and podcasters, it was refreshing to hear how someone so young had the maturity to diversify his wealth at a very early age. Enough has been said about content creators and how much money they make. Raj was transparent enough to actually reveal it. Hopefully this gives you a window into Raj's investment philosophy.
Let's make it a math problem for people.
Let's do that.
So my average expense per month, including my rent, lifestyle, my dog expenses, my current everything, is around 3 to 3.5 lakhs. Okay, that includes my lifestyle, everything fun, and I live alone. So 3.5 lakh. I have enough money that I can sustain this lifestyle, including the, let's say, inflation agar 7 to 8% se hota hai. Considering that, I can live off without making a single penny for next 100 years.
Okay.
I think that's a good answer for people to just...
I have the number in my head, but we'll let this be trivia and we'll put it up on the screen maybe.
And just a disclaimer, it's not the money which I have which is sustained, it's the interest which I make on the money which will help me sustain this.
Yeah, so you're assuming there'll be some capital growth happening on the money that you have which will help you sustain this lifestyle with 7% inflation.
Yes.
How does Raj invest? Like, what does Raj do with his money? Where do you put it?
And for the benefit of everyone, this is not Raj telling us where to put money, just to be really clear about it. But what do you do with it?
Okay. I do a lot with my money. So now this is how my portfolio looks like. Abhi recent बताता हूँ. Do you want me to talk about how it looked and now how does it look?
Yeah, I think the journey, like, because as an influencer, you started making money over a period of time. It's not like you were like got a certain chunk of money. Over a period of time, your income evolved, right?
In the beginning, I used to only invest everything back in my business. To me, a lot of creators make this mistake. They make money. They don't have the teams. They don't have like the setup. They don't have next project. They don't have other things to do on. They really just go like, okay, this की वजह से मैंने कमाया मैं वो और करते जाता हूँ. I think more like a person who's going to do something tomorrow and create a bigger impact. So that's why I reinvested every penny into business. Even today, like 50% of my money is getting reinvested in the business. I'm hiring more people than I need to. I'm getting into more projects than I need to. I'm trying to experiment and learn more with other things. So that is the 50% of money straight up goes there. Okay. Now 50% remaining. Okay. Out of this 50%, a large chunk goes to real estate. Because real estate, I mean lands. Buy barren lands and then, resell it at a higher value in 2-3 years. Because I come from Indore and that's where like the land and everything super booming.
Incredible growth in that region.
Wild growth, wild. I've never seen एक साल में 3x, 4x growth hona. So that's happening there. So that's why I invest a lot of money there. Then the next chunk of like a small chunk is going into mutual funds, which I just invest. सालों से वो चलते जा रहा है कि हर महीना जितने आएगा उतना वो invest होते ही जाएगा. That is one. Then I invest small amount in US stocks. Very small. Where like every month, like $1 lakh or something like that, that's just getting reinvested in US stocks. That I've picked up 5-6 stocks based on one app. I don't know the science behind it. App से मैंने पूछा था, app को मैं बहुत trust करता हूँ उसको. तो मैंने उनसे पूछा तुम्हारा top 6 वो कौन से हैं? उन्होंने बताया, मैंने डाल के invest कर दिया. I'm happy with it. That was just one thing where I did it. Then a small chunk is I think 5 to 7%. I call it experiment money.
Sure.
Which allows me to learn new things. So I invest in sneakers. I invest in wine. I invest in crypto. I invest in NFTs. This is just an experiment money 5% where I'm trying to understand how does these things work. Where I've lost money in crypto, I've made money in NFTs, I've lost money in wine, I've made money in sneakers. Right, तो वो अपने हिसाब से बैलेंस चल रहा है.
That's all, folks. I've thoroughly enjoyed each and every conversation with these wealth creators and can't wait to share our future lineup. And thank you for your support this last year. See you in the next episode of the Create Wealth podcast.